Our next guest says that the Credit Suisse company there needs a buyer. Credit Suisse needs a buyer. Let's welcome in Stephen Kelly, Yale School of Management Senior Research Associate. So why does Credit Suisse need a buyer?
Well, they need a new parent, basically, someone who the street trusts. So what we've seen over the last few months is sort of a slow bleed from Credit Suisse, right? They've lost employees all over the globe. Nobody's really trading with them anymore. Using their businesses to the extent they were. That was some of what we saw reported out of their latest quarterly numbers. Huge drops in trading through Credit Suisse, 96% in the case of equities. But now, just yesterday, BNP Paribas came out and said, we're no longer accepting, to be a counterpart to derivative trades with Credit Suisse. So that's the street starting to say, we no longer trust this entity to be around. This business model is not viable. They need a new parent, someone that comes in and says, we stand behind their contracts. We like the franchise value of the firm, and we're gonna adopt it into our structure.
I want to take a step back for a minute, Stephen, if you don't mind, because we are talking about really two different crises here when we talk about what's happened over the past couple of weeks. We're talking about, on the one hand, Signature, Silvergate, Silicon Valley, and their failures. And then we're talking about Credit Suisse and the sort of international banking system. You're somebody who studies banking systems, right, and systemic crises, potentially. How should we be thinking about? What's your framework for thinking about these two different situations?
Yeah, so this kind of goes to show how systemic risk is really a moment-dependent thing. I mean, we're talking about small banks in the U.S. that are causing problems, maybe globally, maybe contagion globally, and Credit Suisse has been bleeding for 4 months, and we really saw nothing. So this, Credit Suisse has sort of been a slow burn and could have been a test of the new international regulation regime. If it hadn't sort of been infected now with what's going on in the U.S., where we sort of stepped in for really what were small banks and said, look, this is a systemic risk. So we'll see how this plays out. I don't see really there's not really much connection between the two. The similarities are that these are business models that just don't look good anymore. Credit Suisse has shown over the last few years really how it's not very good at being a bank. Lots of scandals, lots of major losses. And this is kind of what we saw out of SVB and Signature too. They had business models that don't look viable into the intermediate future in a world with interest rates this high.
The other similarity is that this can net out in either fire sales or some type of consolidation in the sector. And so is that, from your perspective, a net positive or negative if we do have more consolidation of bigger banks going after smaller banks at extreme deal prices because they're just buying it for parts at that point?
Yeah, this is sort of one of the tensions in crisis fighting, I guess, which is that the best thing to do and what we know works is sort of an aggregation of balance sheets across the system. So what you don't want is one bank to fall and then you start worrying about the next bank and the next bank. So if you can sort of aggregate the banking system and say, look, the system as a whole is solvent, you can typically arrest the crisis. So what we see is that, in a crisis, we see more consolidation. And then after crisis, we see legislators complain about the degree of consolidation. So we'll see what lesson Congress learns from this. This should be sort of an endorsement of the big bank diversified model. We're seeing the big banks sort of come to the rescue of what's going on in California right now. But I could see them saying, look, big banks still aren't safe enough. Congress tends to love the small bank, the community banker, but they're more fragile. They're less diversified. And that should be the takeaway here.
They're more fragile, but people still probably shouldn't be pulling their money out. I mean, does the FDIC need to make do they need to make everything insured? Do they need to make all deposits insured?
Yeah, so this is something that they did in 2008, and they said system-wide uninsured transaction accounts are now insured, and Congress took this authority away. So again, deeply unpopular, rescue measure. Crisis fighter discretion tends to be really unpopular in the aftermath, but now the FDIC no longer has this authority until a bank is already in receivership. So that's why we saw it with SVB and with Signature. And that's probably why we got the systemic risk exception like we did, because the FDIC doesn't want to wait until a much, much bigger bank is in receivership to start being able to guarantee deposits. So this is a move for Congress right now. If it wants the FDIC to insure the system, Congress has to pass a law.
Well, let's hope we don't end up with a much bigger bank in receivership, that's for sure. Stephen Kelly, thanks for your perspective this morning. Yale School of Management Senior Research Associate Stephen Kelly.